Hi, so this is Ranjit Bide. I thought of making a small video to explain the analysis and step by step events of how did the two banks failed in USA and what was the root cause analysis, etc. So as we use it in engineering languages, if we go step by step behind, we find the root cause of the problem. So here in the two banks which failed, you must know that in March 23, SVB, the Silicon Valley Bank was closed, and also First Republic Bank was closed, and there was third. But we are not talking about the bank called Credit Suisse. Credit Suisse, the reasoning of closure of Credit Suisse Bank is completely different. So we'll not be talking about that analysis just now. So let's stay focused on SVB. And SVB, as you know, is a California based or was a California based bank called Silicon Valley Bank. It had started with the main intention of servicing the customers in tech areas and life sciences areas. It in March 2023 it was closed down by the Fed. So the main root cause of this, as you will see when I explain, is basically inflation. Now let me explain how this happened. In the last year, as you all know, Russia attacked Ukraine, and we'll not go into the details of that. But due to that, the oil prices soared up, gas prices soared up. There were not enough food grains, etc., etc. You also know that Ukraine was basically one of the biggest suppliers of wheat and corn products. So there was a lot of problem, and also the conveyance stopped, the ships stopped, so there was supply side problem. So because of this supply side problem, the inflation soared up. So the daily prices went up, and the prices went up all over the world. Now, how this is related? So as the inflation goes up, the central bankers, that means the bank which is at the helm of the all banking affairs in the country, is called central bank. Like we have Reserve Bank of India, they have Federal Bank in USA. So the central bankers all over the world started increasing the interest rates. Whenever the inflation goes up, the main tool that the bankers have in their hands is to raise the rate of interest. Okay. Now the problem is the inflation goes up suddenly. The oil prices suddenly shot up from $70 to $125 in a span of just two weeks or 1 month. But the bankers cannot raise the interest rate so fast. So they will go step by step. First of all, they will wait and see whether the things is down or not. They don't. Then they will increase the interest rates by half a percentage point, that is 50 basis points. Then they will raise it again by 50, etc., etc. So they will start raising the interest rates, and they will try to raise the interest rates to such an extent that it passes the inflation. So you understand? Suppose the inflation in some cases, let's say 5%, they will try to increase the interest rate to 6%. Now this difference between 6% and 5% is called the real interest rate. That means the interest that you get from the bank will be 6, the inflation will be 5, and you will have 1% in your pocket. That is called real interest rate. Now here the situation was bizarre. Here the inflation went up to 8%, 9%, 10%, even in America, UK, various Europe countries, etc., etc. And the interest rates at that point of time, when the war started in February 2022, the interest rates were negligible. They were 0.25, 0.5%, and things like that. So they started to raise interest rates, and there was a lot of problem in the banking system as to where are they going to raise interest rates up to. Now, what is the problem with raising interest rates? On one side, it will try to contain the inflation, but on the other side, people will stop taking loans because their loans become costly. The EMIs will become costly. Like you must have had the EMIs for home loans or your car loan, etc. As the interest rates go up, the EMIs go up. So less and less people will try to avail the loans. Now, if the less people try to avail the loans, the economy will stall, and therefore this demand will come down, and then the inflation will also come down. That is the whole economics part of it. But the problem in the whole system was such that USA people did not know up to what are these interest rates going to be raised to, what is called as the terminal rate. So at about 1 month ago, the interest rates were about 5.1%, and the Fed was talking about terminal rate of about 5.5%. That means there are one or two iterations of inflation, interest rate hikes still in store. Now let me come back a little further in this story. As the interest rates go up, something very bizarre happens in the bond rate. We are all familiar with equity markets, but we are not generally familiar with the bond market. Actually, the bond markets are 10 times bigger than the equity markets. And bond markets are such that suppose a government issues a bond of 100 rupees, they will take 95 rupees from you, and they will tell you that they will give you 100 rupees at the end of the bond period. That means the 3 year period or 5 year period, 100 rupees. So that means that 5 rupees less that they take is called the bond yield. Now, as the interest rates go up in the banks, the bond yields start wavering. Now, here what happened in USA was the whole confidence in the system was so low that as the interest rate started going up, the bond yields started wavering so much that generally the 1 year or 2 year bonds would have a bond yield of 2%, 3%, 4%, still much below the inflation rate, and the 10-year bonds would have the bond yields of 8% or 10% or 7%. But since the confidence was very low, the bond yields become reversed. That means the 10-year bonds were getting less interest or less yields in typical bond terms than the one or two short-term bonds. Now, what is happening in SVB Bank, or what was happening in SVB Bank? SVB Bank. Now, this is one part of the scenario. Now, let's come to SVB Bank. SVB Bank was basically funding a lot of people in tech stocks and life science stocks, as I told you, and therefore these companies raised a lot of money from PE funds and VC funds. They raised monies in the range of 1 billion, 2 billion, like that, and they wanted much lesser than that for their regular expenditures. So they put, or they typically, as they say in banking term, they parked their money in the deposits in SVB Bank. So 300 million, 500 million, like that, big chunks of money was parked in the SVB Bank. So those were the deposits of SVB Bank. Now this was fine for SVB Bank till 3 months ago or 6 months ago when the interest rates were low. Because how does the bank operate? Bank operates on something called as NII, net interest income. They take money from you, which you call as deposits, and they lend money to some people, businesses. So there is a deposits and then there is lending, and the difference between the two is the NII, that is the net interest income. Now, coming back to the SVB Bank, so in the earlier times when the interest rate was very low, this was fine that they were keeping the deposits with them. What happened was, this big chunks of deposits which the SVB Bank got, they didn't know what to do with it. So in the last 2-3 years, and SVB Bank is not a small bank, it is the 16th largest bank in United States. When they got such big chunks of money, they started parking their funds somewhere else. And where to park? The best way is to park it with USA sovereign bonds. So the sovereign bonds can be 1 year bond, 2 year bond, 10-year bonds, as I told you. Now these sovereign bonds were 10-year bonds with which they parked money. Why? Because they were getting better yield, 7% yield, 8% yield, and things like that. Now, when this interest rate started going up, the Fed started increasing the interest rate, and the bond yield started reversing, what is called as the inverted yield curve. That means 1 year bond or 2 year bond started getting equal to or more yield than a 7-year or 10-year bond. So the inverted yield started taking place, and this all has become because the confidence in the system was shaken hugely. Now, SVB at the same time, this long-term bonds that they were holding, they are called HTM, that is hold till maturity. That means you hold a bond for 8 year. If it's an 8-year bond, you hold it till 8 year, and you will get your money back at the end of 8 years. Now, what happens? Is there a way of liquidating a bond? Yes, there is, because these bonds are traded on the stock exchanges. So you can trade the bond on the stock exchange, but obviously you will not get that yield. So if you have a requirement of money, they will sell those bonds on the stock exchange. So what was happening? Once this whole confidence level was shaken and the yield started inverting, I told you about the bond yields inverting, they had to show that they were making a notional loss on the HTM bonds, the hold till maturity bonds. So if that loss, that means the yield has come down. So if the bond yield was, let us say, 8% to start with, and it has come down to 5%, there is a 3% loss. And they have to show that loss on the balance sheet. Now, where will they show that loss? It's a notional loss, it's a paper loss, because they have not booked that loss yet. But if they book that loss, then it is called mark to market loss, MTM. So HTM becomes MTM. Now this whole thing suddenly got the wind, and some people who were in this tech business, there was a tech downturn about 6 months ago, if you remember. So some people wanted money back. So the money that they had parked with SVB, they wanted those deposits back. No problem. But where will they give the deposits back from? They will give the deposits back from their own capital or from their free cash flow that they have. So if one or two or 10 people come and ask me as a banker the deposit, I'll give it back to them. But if 100 people come, I cannot. Then my capital will get eroded. If 1000 people come and ask me the deposit back, what will happen? I have a problem. I don't know where to ask the money. So what I will do, I will liquidate those HTM bonds, and for that I will have to sell them, and then that loss becomes real. That means I have now sold the bonds to liquidate my money and to give it to people who have asked for the deposit. Now, as I told you, this one or two or 10 people come, no problem with the deposit giving back. But 1,000 people come, suddenly I don't have money, and that is called as run on banks. Now, this run on banks is a very, very, very difficult thing to handle, and any bank, absolutely any bank of any size, if there is a run on bank, it will fail. So, what has happened, you will understand, is that inflation gave rise to interest rate hikes. Interest rate hikes gave rise to clear inverting yield of the bonds. Those bonds gave rise to MTM, mark to market losses, and those mark to market losses, those were shown on the balance sheet, and people become jittery and they started withdrawing their deposits. And then there was a run on the banks, and that run on the banks could not be held by that could not be saved. So they had to liquidate all the bonds, and the bank had to close. So this is a step-by-step analysis as a logical. I'm not a banker. I'm not an economist to tell you in very great details, but this is the way I understood it. This is the link from this end to that end as to how the banks fail. There is one more thing in this SVB banks which may be of mention, which I should mention to you. In USA, there is a law that if there is a deposit of, let us say, $250,000, a deposit, then it is insured. That means what? If suddenly the bank fails, then the insurance will step in and give the depositor $250,000. But as I told you, these people had put millions of deposits. That means 200 million, 300 millions of deposits. So there is no insurance. That is called uninsured deposits. So these uninsured deposits, when these people started the run on the bank, these uninsured deposits could not be serviced through the insurance of the deposits, and therefore the run on the bank took place. Now a further development took place in the last 2 weeks or so, that Yellen and other people from Fed, they said that what we will do is we will make sure that all the deposits will be given back. That means even the uninsured deposits, not just up to $250,000, but even more than that will be made good. That means if somebody wants to withdraw the deposit of say 2 million rupees, then also he can withdraw 100 million rupees also he can withdraw. Now where will that money come from? Obviously the money will come from the Fed, or somebody will have to give that money, and that is a big problem. So even now the problem is far from over, and now there was a report that there are such 186 small or medium banks which have the same problem of mismatch of liability. As I told you, the inverted yield curve and the deposits being kept into long term HTM. This mismatch of liability is a big problem, and probably 186 banks are vulnerable in this manner that they can fail if there is a run on the banks. So this was my attempt to try to explain to you how the whole thing took place. Thank you.